Stage 1. The warning nobody notices. Something shifts long before headlines catch up. Not in the stock market. Not in unemployment numbers. Not in the loud, obvious places people are trained to watch. It starts somewhere quieter. Less dramatic. Almost invisible unless someone knows exactly where to look. Oil. Prices begin to climb. At first it feels like background noise. A few extra dollars at the pump. A passing complaint. Nothing that feels like the beginning of something bigger. But historically, this is where the story always begins. Over the last 50 years, major economic downturns have shared a common thread. Oil doesn't just rise, it surges. Not 10%, not 20, 30% or more. And when that happens, something deeper starts to break beneath the surface. Now imagine this. Gas prices tick upward again this month. Maybe they were already high. Maybe the increase feels annoying but manageable. Life continues. Work, bills, groceries, routines. No alarms go off. But behind the scenes, that quiet increase is sending a signal the economy has never ignored for long. Because oil isn't just fuel for cars. It's the foundation of everything. Every truck delivering groceries. Every factory producing goods. Every plane in the sky. Every ship crossing oceans. When oil gets expensive, everything built on top of it starts to feel the pressure. At this stage, though, almost no one connects the dots. The stock market might even be near all-time highs. Confidence remains strong. Conversations stay optimistic. And that's exactly why this stage is so dangerous. Because the warning doesn't feel like a warning. It feels like nothing. Stage 2. The illusion of stability. This is where things get misleading. Life looks normal. Markets appear strong. Jobs seem stable. Paychecks still arrive. There's no immediate sense of crisis, no breaking news telling people to prepare, and yet the underlying pressure is building. The reason is simple, but rarely talked about. Economic damage from oil doesn't hit instantly. It lags. Historically, there's a delay of about 12 months between a major oil spike and the visible economic fallout. That delay creates an illusion. Everything appears fine, right up until it isn't. Looking back, the pattern is almost unsettling in how consistent it is. Oil surged in the early 1970s. The recession followed the next year. Oil spiked again around the Gulf War. Another downturn followed shortly after. In 2008, oil reached extreme highs. Months later, the financial system cracked. Same sequence, every time. First the energy shock, then the consequences. That gap in between is where people continue living as if nothing has changed. Imagine someone filling up a car on a Tuesday morning. The price is higher than last month, maybe noticeably higher. There's a quick reaction, frustration, maybe a shrug, and then the day moves on. Work still needs to get done. Bills still need to be paid. Life doesn't pause just because oil prices moved. But that moment at the gas station isn't the end of the story. It's the beginning. Because what feels like a small increase in fuel cost is quietly spreading through the entire system. Shipping costs rise. Production costs climb. Food becomes more expensive to grow and transport. And none of it shows up all at once. It creeps in. Stage 3. The global trigger. Every recession has a trigger. Sometimes it's financial. Sometimes it's policy-driven. Sometimes it's tied to something much more physical and immediate. In this case, the trigger sits in a narrow stretch of water halfway across the world. The Strait of Hormuz. It's not wide. At its narrowest point, it's shockingly tight for something so globally important. And yet, a massive portion of the world's oil supply passes through it every single day. That means any disruption, any tension, any delay, any rerouting doesn't stay local. It spreads. Tankers take longer routes. Shipping times increase. Costs rise. And because oil is priced globally, those increases don't stay confined to one region. A price spike in one part of the world becomes a price spike everywhere. It doesn't matter how much oil a country produces domestically. The global price sets the tone. So when oil surges, it hits everywhere. From major cities to small towns. From industrial sectors to everyday households. And this time, the surge has already crossed a critical threshold. More than 50%. Historically, 30% has been enough to trigger economic stress. This is already far beyond that line. And still, the broader economy looks stable. That's the unsettling part. Because at this stage, the cause is already in motion. The effect just hasn't arrived yet. Stage 4. The slow spread into everyday life. This is where things begin to feel different. Not dramatically, not all at once, but enough to notice. Gas prices don't just rise once, they stay elevated. Filling up the tank becomes something people think about more carefully. Driving patterns change slightly. Trips get combined. Small adjustments start happening without much discussion. Then groceries begin to shift. Not in obvious ways at first. A few dollars more here, a slightly higher total there. Nothing shocking, just consistently higher. Month after month, food production relies heavily on energy, fertilizers, transportation, storage. Every step depends on fuel in some form. So when oil rises, food quietly follows. What used to cost $600 a month starts creeping upward. 700, maybe more, not because of one big change, but because of dozens of small ones stacking together. Then come the less visible pressures. Shipping costs increase, which affects retail prices. Manufacturing slows slightly as costs rise. Businesses begin to feel the squeeze. And here's where it becomes more complicated. Because households aren't entering this phase from a position of strength. In previous shocks, there was a cushion. Savings were higher. Financial buffers existed. People had room to absorb rising costs without immediately cutting back. That cushion is no longer there. Savings levels have dropped back toward historic lows. At the same time, debt has increased. Interest rates remain elevated. So instead of absorbing the shock, households start feeling it immediately. The same type of oil surge that was manageable before now hits much harder. It's the same storm, but very different starting conditions. Stage 5. The pressure on big financial decisions. At some point, the rising costs stop feeling small. They start influencing bigger decisions. Housing is usually one of the first areas where this becomes obvious. When oil drives inflation higher, central banks face a difficult choice. Lower interest rates to support growth or keep them elevated to control rising prices. And when inflation is tied to something like energy, it becomes harder to bring down quickly. That often means interest rates stay higher for longer. Mortgage rates follow. For anyone waiting for rates to drop before buying a home, that window begins to close. What looked affordable 6 months ago starts to feel out of reach. Monthly payments rise, not because of a lifestyle change, but because of shifts in the broader economy. Even small increases matter. A fraction of a percent in mortgage rates can translate into hundreds of dollars more each month. And that changes decisions. People delay buying. Others stretch their budgets further than planned. Some walk away entirely. At the same time, investment portfolios begin to react, particularly those heavily weighted towards sectors sensitive to interest rates and economic growth. Technology stocks, for example, tend to feel pressure when rates stay elevated and growth expectations slow. So while the stock market might still appear stable on the surface, underlying cracks begin to form. Retirement accounts don't collapse overnight. They weaken gradually, and often the damage isn't immediately obvious. By the time it becomes clear, some of the impact has already settled in. Stage 6. The tipping point approaches. This is where everything starts to converge. Higher fuel costs, rising grocery bills, elevated interest rates, increasing financial stress on households, slowing business activity. Individually, each piece feels manageable. Together, they start to weigh heavily on the system. Consumers begin pulling back, not out of panic, but out of necessity. Spending slows, businesses notice. Hiring decisions change. Expansion plans get delayed. And slowly, the momentum of the economy begins to shift. Not abruptly, but steadily. This is the phase where the earlier warning signals begin transforming into real economic consequences. The 12-month delay starts to close. What once felt distant becomes immediate. And yet, even here, there's still uncertainty, because recessions aren't guaranteed. Sometimes shocks fade, prices stabilize, the system absorbs the pressure, but when multiple factors align, and when households lack the financial buffer to withstand them, the risk increases significantly. That's where things stand now, right on the edge of that transition. Stage 7. The moment the economy turns. At some point, the shift stops being subtle. What was once a slow buildup of pressure begins to show up in places people can't ignore anymore. Businesses start adjusting first. Not dramatically at the beginning, just small decisions. Hiring slows. Open roles stay unfilled a little longer. Expansion plans get pushed into the future. Then those decisions start stacking. Fewer hires turn into hiring freezes. Delayed plans turn into canceled projects. And eventually, the conversation changes from growth to survival. This is where the economy turns. Because businesses don't wait for confirmation of a recession. They react to pressure. Rising costs, slowing demand, and tighter financial conditions force action before any official announcement ever comes. And once those actions begin, they ripple outward. Employees feel it next. Hours get reduced. Bonuses shrink. Raises disappear. And then, for some, the layoffs begin. Not everywhere at once, but enough to change the tone. Stage 8. The job market cracks. The job market is usually the last thing to break, and the most visible when it does. At first, it feels like isolated news. A company announces layoffs, then another, then a few more. Each one has its own explanation: restructuring, cost optimization, strategic realignment. But underneath those words is a shared reality. Demand is slowing and costs are rising. Companies start protecting margins, and payroll is one of the largest expenses to adjust. So cuts begin. Unemployment doesn't spike overnight. It rises gradually. Quietly at first, then more noticeably. What used to feel like a strong job market starts feeling uncertain. Finding a new job takes longer. Offers become less competitive. Negotiating power shifts away from workers. And for those who lose their jobs, the timing couldn't be worse. Because this isn't happening in isolation. It's happening while everything else is already more expensive. Gas, food, housing, debt payments. The same pressures that triggered the downturn are still there, now combined with reduced income. That's where the real strain begins. Stage 9. The financial squeeze tightens. This is the stage where everything connects. Income becomes less stable. Expenses remain elevated. Savings, already reduced before the downturn, start to disappear faster. What once felt like manageable increases now feel overwhelming. That extra $700 a year on fuel, the additional cost of groceries every month, higher mortgage or rent payments, all of it stacks together. And without a financial cushion, there's very little room to adjust. So people start making changes. Spending gets cut back first. Dining out less, canceling subscriptions, delaying purchases. Then bigger decisions follow. Postponing major life events, holding off on buying a home, selling assets to cover expenses. And this is where a key difference shows up between those who prepared and those who didn't. Because during economic stress, access to cash becomes one of the most important factors. Those with savings have options. Those without it face constraints. And those constraints shape outcomes. Stage 10. The market reality sets in. While households are adjusting, financial markets begin reflecting the new reality. What once looked stable starts to shift. Stock prices don't collapse all at once, but volatility increases. Certain sectors feel more pressure than others. Industries tied to growth expectations begin to slow, higher interest rates continue weighing on valuations, and retirement accounts, especially those heavily concentrated in specific sectors, start showing signs of stress. This is often when people begin checking their balances more closely, and for many the realization comes late, because markets tend to react ahead of the broader economy, but the full impact isn't always immediately obvious. Losses accumulate gradually before they become visible, and by the time they're fully recognized, some of the damage has already been done. That creates a difficult situation. Selling locks in losses, holding carries uncertainty, and making decisions becomes harder in the middle of volatility. Stage 11. The divide becomes clear. This is where the recession stops being just an economic event. It becomes a personal one, because not everyone experiences it the same way. Some households manage to stay stable, others fall behind quickly. The difference often comes down to starting position, savings, debt levels, job stability, flexibility. Those who entered this period with financial reserves can absorb shocks. They adjust, but they don't collapse. Those who entered already stretched feel the impact immediately, and for them, each additional cost, each reduction in income, each unexpected expense carries more weight. The gap between those two groups widens. Opportunities that exist during downturns, like buying assets at lower prices, are only available to those with liquidity. Everyone else is focused on getting through the month. And this is one of the most consistent patterns across economic history. The people who suffer most aren't always the ones who made the biggest mistakes. They're often the ones who didn't have the margin to begin with. Stage 12. The people it leaves behind. Every recession eventually ends. Markets recover. Growth returns. Headlines shift back to optimism. But not everyone moves forward at the same pace. Some people regain stability quickly. Others take years. And some never fully recover to where they were before. This is the part that rarely gets discussed in detail, because it's not about charts or percentages. It's about real lives, jobs lost that aren't replaced at the same level, savings that took years to build and months to disappear, opportunities missed because the timing didn't allow for risk, financial decisions made under pressure that have long-term consequences, and for many, the impact lingers long after the official recession is over. That's what makes the early stages so important. Because by the time the downturn is visible to everyone, most of the positioning has already happened. The outcomes are already being shaped. The full picture comes together. Looking back across all these stages, the pattern becomes clear. It starts quietly. An oil spike that most people don't connect to anything larger. Then a delay, a period where everything feels stable, even as pressure builds underneath. Then the spread. Costs rise across everyday life. Big financial decisions become harder. Businesses adjust. The job market weakens. And eventually the full weight of the downturn becomes visible. Not all at once, but step by step. And throughout that process, one factor keeps showing up again and again. Preparation. Not perfect timing. Not predicting the exact outcome. Just being ready for the possibility that the pattern plays out again. Because historically, the people who struggled the most weren't the ones who prepared early and turned out to be overly cautious. They were the ones who waited for certainty, and by the time certainty arrived, the window to prepare had already closed. A recession doesn't arrive as a single moment. It unfolds, stage by stage, signal by signal, decision by decision. And by the time it becomes obvious, it's already well underway. Right now, the early signals are active again. Oil has already crossed the threshold that has preceded past downturns. The delay window is in motion, and the financial cushion that once softened the impact is no longer there. That doesn't guarantee what happens next, but it does define the risk. And understanding each stage changes how that risk is faced. Because when the pattern is visible, the outcome is no longer a complete surprise. It becomes something that can be prepared for. If this breakdown helped make sense of how recessions actually unfold step by step, consider subscribing for more deep dive content that connects real-world events to everyday impact. Sharing this with someone who's trying to understand what's happening in the economy right now could make a bigger difference than it seems.